This is Nightly Business Report with Tyler Matheson and Susie Gehring.
Another day, another record. The Dow ends at a second consecutive all-time high as the Federal Reserve says the economy is growing, but modestly.
And America's energy future. In focus, a special report on a sector that could power U.S. growth and jobs for decades.
And stormy weather, a big problem for you, but also a big pain for business. How Mother Nature is the great disruptor. And welcome to all of our public television viewers. Tyler, another day of stocks and the economy grabbing the headlines.
The stocks once again, another day, the Dow jumps over the moon. The blue chip index adding 42 points. The broader S&P 500 was up 1. The NASDAQ, though, edged nearly 2 points lower, pulled down by Apple and Google. Now, the markets began the day higher after better than expected news about jobs, with payroll firm ADP reporting 198,000 private sector jobs were added back in February, more than economists expected. Also helping today, applications for new mortgage loans shot up 15% last week after home mortgage rates edged a tad lower.
Well, new records have a way of making investors feel optimistic. They also trigger new worries as people try to figure out if the next milepost is Dow 15,000 or Dow 13,000 again. At these heights, there's fear of the unknown and plenty of caution flags flying. Is it too late to get into the stock market? That was the question individual investors were asking all around the country today. The headlines and the euphoria about a new milestone for the Dow were tempting for many investors and scary for others at this Charles Schwab Center in New York City.
I think there's a game in the back room that we're not allowed to see.
Even some Wall Street pros have their doubts.
This is one of the most reluctant new highs I've seen in a long time.
Many strategists say that it's better to buy at a market bottom, not when the averages are hitting new records. They also point to problems that could pull down stocks.
I think people wanted higher volume. They wanted more conviction.
Any absolute language from the Fed that would, curtail any further intervention and easing.
Also on the worry list, a weak economy, budget cuts in Washington, uncertainty about China's economy slowing down, and the continuing financial crisis in Europe.
I don't think that's priced in the market right now, so you might get a terrible reaction to the downside.
But money keeps flowing into stock funds. The latest numbers from the Investment Company Institute show investors have put about $20 billion into U.S. stocks so far this year. And there's still a lot of cash on the sidelines. That's why market pros don't want to count out the bull run just yet.
Around the kitchen tables and dining room tables, people have got to be talking about, okay, we were very nervous about the market, but stocks have moved up. So, Marge, should we get in or not?
And coming up a little later on the program, a closer look at what's fueling the rally. We dig into where the money is coming from.
Well, a lot of credit for the recent bull run is being given to Federal Reserve Chairman Bernanke. He gave stocks another boost today. The Fed did with its latest Beige Book survey of economic conditions around the nation. And Steve Leisman gives us a closer look at what the central bank found.
The consumer is troubled, according to the Federal Reserve's latest Beige Book. The Beige Book is a collection of economic anecdotes from the Fed's 12 districts around the country, and it helps policymakers figure out, beyond the data, what's really going on in the U.S. economy. What they found was a mixed picture on consumers. They're still spending on autos and tourism and services, but retail is struggling. According to the Beige Book, retail sales were better in only 5 districts and flat to weaker in 7. The district said retailers complained of higher payroll taxes, which went up this year, high gasoline prices, and government spending cutbacks. One positive piece of news, residential real estate. According to the Beige Book, it was up in most districts with strengthening home prices and falling inventories. New home construction also increased.
Labor markets were described as somewhat better, but hiring was restrained, and one Fed district blamed the health care law.
The Richmond Fed wrote in the Beige Book, employers across the district continue to cite the Affordable Care Act and its unknown impacts as reasons for planned layoffs and reluctance to hire more staff. Fed officials are likely to read this report and find good reasons to continue their policy of trying to stimulate the economy by keeping interest rates at zero and buying treasuries to try and push down long-term rates. For Nightly Business Report, Steve Leisman.
Meanwhile, a top Federal Reserve policymaker warned today that there are risks associated with the central bank's massive bond buying program. Charles Plosser, he's president of the Philadelphia Fed Bank, wants the Fed to slow down its monthly purchases of bonds. Speaking to a business group, Plosser, who is not a voting member of the Fed's policy committee, says those big bond purchases are posing risk to the economy that could hurt financial and price stability.
Lawmakers want to make sure Washington doesn't collapse. The Republican-controlled House passed a resolution today that'll keep the federal government up and running through the end of September. Now, that measure, which extends the spending cuts that went into effect March 1, now goes to the Senate. Senate leaders say they'll tweak the bill, but will probably pass it. Meantime, keeping the federal government up and running past March 27th is going to be a focus of a dinner that the president is hosting tonight with top Senate Republicans at a Washington hotel.
So we told you yesterday that many individual investors are still skeptical about this market. But as Jane Wells tells us, they are jumping in, but in their 401ks.
A funny thing happened on the way to the new Dow Record. The American government may be a fiscal mess, but the American people are optimistically pouring money into stocks.
Most of my retirement money is in the stock market.
I have a retirement fund and they invest in all different things.
I have Microsoft, I have AT&T, I had Hershey, I took that out.
I've got about 90% of my retirement account in stocks right now.
Fidelity reports the average 401k account hit a record $77,000 by the end of last year. For those over the age of 55, the average account topped $143,000, and it averaged $225,000 for 1 million investors using both a company savings plan and an IRA.
We're seeing a renewed confidence in the housing market. People, I think, feel more confident about putting money into their 401k and not seeing it drop into the proverbial black hole.
Betsy Ballard says that's especially true on the nation's coasts, where housing cratered the most and is now recovering. William Blair & Company says as employment improves, more workers are becoming eligible for 401k plans, and that could be good for target date retirement funds. But even trading outside of 401k accounts seems to be rising. Schwab and E-Trade report increasing trading volumes.
On the other hand, while those who stuck with the market through thick and thin are now back to thick, their emotional recovery may not be as robust as their 401k recovery.
Like people have been saying, you've got to be careful right now. So that's, I think you just have to use common sense.
What goes up must come down.
It's a bubble.
Explain that.
Well, money's worth nothing. You can't make any money on your in your account, in your savings account. So everybody's trying to build up the stock market to get dividends and make some money out of their money.
The concerns, I think, have been the same concerns that have been with us since 2008. Is this real?
Is this real? It is for now. For Nightly Business Report, Jane Wells, Los Angeles.
All right, a lot of differing opinions. Let's get some more insight on the individual investor and what they should do next. Joining us now, Tom Bradley is president of retail for TD Ameritrade. Tom, I bet you had a lot of questions today from individual investors. Should I get in? Is it safe? What were you telling them?
We sure did. Well, the key here is that to look at the long-term trends, and then you have to determine your time horizon. The long-term trends in the stock market are up. And as long as you're 5 to 10 years or more out, then the stock market is in your favor. It's an incredible way to build wealth.
Tom, the last two times the markets hit multi-year highs, back in the year 2000, it was at the end of a bubble. It was the tech bubble. In 2007, there was a housing bubble. What do you say to a person like that, a person in that tape piece there, who says, it's a bubble again, and I'm going to get hurt again?
Again, you have to go back and look at the long-term trends. And now, it's very different, a retired person versus a younger person that still has many years of earnings left ahead of them, and it depends on how much risk you want to take. So that's the key. If you are closer to retirement, you may want perhaps 25% of your portfolio in equities. If you're much younger, you're still earning a living and saving money, then you'll want a much greater percentage of your portfolio in equities.
All that makes so much sense, but when you're talking to somebody about their retirement savings, about college savings plans, they're still worried about putting in money into stocks, even though they see the markets going up. How do you reassure them so that they get comfortable and can sleep at night that they're doing the right thing?
stocks are just an amazing way to build wealth. They have been over the long term. They've beaten all other asset classes. I strongly encourage individuals that aren't as familiar with the stock market or aren't as comfortable with the stock market to seek out some help, get some guidance from a professional, not from your neighbor, but from a professional. I'd love for them to come to us. Go to an independent registered investment advisor, a professional that has their best interests at heart, and get some professional advice.
Are you finding that still too many people are too heavily concentrated in bonds? And how do you urge them to leave that safety behind and move into something riskier?
Yeah, a lot of people are asking that question. Actually, we don't have a significant number of investors in bonds on our platform at TD Ameritrade. It's a very small percentage. The ones that are in bonds, we do a lot to educate them on what will happen if they're in longer-term bonds when interest rates start to rise. That's very important. There's a significant amount of principal risk there. But what we do have, it's very interesting at TD Ameritrade, is over 20% of the $500 billion that is on our platform is in cash. Over 20%.
That's amazing.
So a lot of folks on the sidelines, a lot of folks still nervous.
Well, that could be a bullish sign, though. But thanks a lot, Tom. Thanks for coming on the
My
program.
pleasure.
Really appreciate it. That's Tom Bradley, president of the retail at TD Ameritrade. Well, coming up a little later on the program, we go in focus tonight on America's increasing fuel independence. So why are prices still going up? But first, a look at how the overseas markets finished out the day.
Three Dow component companies are at the top of tonight's market focus. First, Microsoft. The European Union fining Microsoft $731 million for breaking an agreement to offer European consumers a choice of rival browsers in the Windows operating system it sells over there in the EU. Microsoft blamed a technical error and has apologized, but hasn't said whether it will appeal that fine. The stock down less than 1% on the day. Speaking of another big company, ExxonMobil told financial analysts that it expects production to decline about 1% this year because of weaker natural gas output and then rise over the next 4 years as 22 major projects come online. The company says it expects to spend $190 billion, yes, billion, over the next 5 years on exploration alone. Exxon shares flat today.
Disney CEO Bob Iger in the hot seat today at the company's annual meeting. Activist shareholder groups questioned his dual roles as CEO and chairman and carped about his compensation. Iger took home more than $40 million last year, but most shareholders gave him the thumbs up for boosting Disney stock by 138% during his tenure. The activist lost on every issue. Disney shares, meanwhile, lost 12 cents, down from yesterday's all-time high. Shares of Staples tumbled today, even though it reported better than expected quarterly earnings. It beat by a penny, but revenues came in lower than expected. And the office supply retailer also warned that full-year earnings will be coming lower than expectations. The stock got slammed, down 7% to $12 and change.
And Icahn to Dell, not so fast. Financier Carl Icahn reportedly taking a 6% stake in the computer maker Dell. Reports are that he doesn't really love founder Michael Dell's plan to team with a private equity firm and take the company private. Icahn favors a different tack and has some company in Southeastern Asset Management, another big Dell shareholder. So Dell may be in play. Dell posted gains for the day.
Now, despite concerns about what the death of Venezuelan President Hugo Chavez would mean to the energy market, crude oil closed lower, but well off the session lows, rising after the Federal Reserve reported modest economic growth across the country. And that brings us to the third installment of NBR's week-long series called In Focus, The American Recovery. And tonight, we look at energy. Here's Sharon Epperson.
It was unthinkable a few years ago, but now U.S. energy independence appears to be within reach. The United States is virtually self-sufficient in natural gas supply and currently has the highest rate of growth in oil production in the world, producing more oil than it has in 2 decades. By the end of the decade, this nation is expected to become the world's top oil superpower, outpacing Saudi Arabia in terms of production.
With a combination of hydraulic fracturing, otherwise known as fracking, and horizontal drilling, the U.S. natural gas position has been turned around, and today the United States is the largest producer of natural gas in the world. And by the end of the decade, we may exceed Saudi Arabia to be the world's #1 oil producer. We'll certainly give Saudi Arabia a very good race for its money.
Here in Texas, unconventional oil and gas drilling is helping to fuel the state's economy, directly and indirectly, creating nearly 580,000 jobs last year and expected to account for 930,000 jobs by 2020. According to research from IHS-CERA, over 1.7 million jobs are tied to unconventional oil and gas development today, extending to every one of the lower 48 states and rising to 3 million jobs by the end of the decade. Building more pipeline capacity, including the Keystone XL pipeline stretching from the Canadian tar sands through the middle of the country to the refinery-rich Texas coast, is also expected to drive employment growth.
Keystone is going to support, according to the State Department, 42,000 jobs in the U.S. Just in terms of the construction alone in the states that we're going through, we're going to put 9,000 Americans to work.
Despite the surge in U.S. oil and gas development, challenges remain as global forces continue to push oil prices higher.
There are various factors that contribute to the cost of crude oil. Unrest in the Middle East, the demand coming out of Asia, particularly China and India and elsewhere around the world, the value of the dollar, a lot of things contribute to that price.
And drive up gasoline prices too, with the national average for regular gasoline near the highest it's ever been for this time of year. Some consumers may wonder when their wallets will see the economic benefit of this energy boom. But without the surge in U.S. oil and gas supplies, fuel prices in this country would be much higher. For Nightly Business Report, I'm Sharon Epperson in Houston.
Freedom from foreign oil. American energy independence has been a kind of political and economic holy grail since the 1970s. But now, as Sharon pointed out, it may actually be within reach. I spoke earlier today with Bob Dudley. He's the chief executive of BP, and I began by asking him whether he thought the U.S. could ever attain the long-standing goal of energy independence.
We think that by 2030, it's very likely to be practically energy independent. And that's not just oil and gas, that's coal and renewable energy as well. I don't think any country should think about it being completely independent because I think all of the energy complex around the world connects itself. But yes, it's fundamentally changed the economics of the U.S.
How will that happen?
Well, it'll happen because of the great massive unlocking of natural gas from the shales, which has occurred 5 years ago, even 2 years ago. People were wondering if this is real. It is real, and that's been a great boost to the U.S. economy. And then this new shale oil, such as what's happening in the state of North Dakota, which now produces more oil than Ecuador, which is an OPEC nation, and the renaissance of what's happening in Northeast Ohio, for example, and in Texas. So oil and gas from new sources definitely happening, as well as the deep waters of the Gulf of Mexico.
I think a lot of people might be concerned that the unlocking of those assets in natural gas and oil shale will pose very serious environmental threats. What do you have to say about that?
Well, I think it has to be done. You're talking about hydraulic fracturing, a nickname of fracking, but it's a technique that has actually been around and used since the 1940s. So it's not something new. It's just how it's being used today. And I think it's something unknown that's happening way under the ground. So it's easy to paint a sort of a sensational picture about it. But it's an unbelievable tool for moving rocks slightly apart and putting sand in between it, so that you unlock these natural gases. And done responsibly, I think this will be something that will be done all over the world now in the coming decades.
You know, not so long ago, people around the world were worried that we might run out. It was the peak oil theory, and we might run out eventually of oil. What is your working supposition about the growth in demand for both oil and energy overall over the next 15 to 20 years? And how do you see that the mix of energy constituents changing?
Yeah, it's a great question. I mean, we've never subscribed to the peak oil theory because we just know there's more and more oil out there, more efficiency for water flooding and wringing it out of existing reservoirs. And you go into deeper waters and the new three-dimensional seismic techniques that allow you to unlock imaging below the ground. There's a lot of oil and gas still in the world. But by 2030, we expect more than additional oil consumption of 16 million barrels a day, and the world itself will need a third more energy. That 16 million barrels a day is the equivalent of, if you combined all of the oil production today from Russia and Canada and the United Arab Emirates together, that's how much more oil we think that the world will be producing and using, along with other forms of energy. So it's an enormous challenge of the industry and governments to allow it to happen economically.
Let me turn to the legal questions that confront BP and several other of the companies that were involved in the Deepwater Horizon drilling matter. There was some supposition weeks ago that you would settle the civil case that is now taking place down in New Orleans. Why didn't that happen, and do you have any prospect of settling even though the trial has begun?
Well, Tyler, we're in court today, so it's not appropriate to say very much about it. We absolutely believe our case. We're going to defend the company's interests. We've spent $25 billion today in cleanup efforts all across the Gulf Coast. We provisioned as much as $40 billion for moving through this. One of the statutes is the company's response, and their responsibility after an accident like that will be taken into account, and we look forward to telling our trial, but our side of the case in court.
Mr. Dudley says, by the way, that he has full faith in the American justice system, and to put any suppositions to rest, that he and BP are committed to doing business in the United States. Tomorrow on Nightly Business Report, we continue our special series on the American recovery. In focus tomorrow, the state of retail and the consumer.
And coming up a little later in the program, the snow quester and the costly effects of the bad weather hitting the Midwest and the Atlantic coast. But first, a look at where metals and treasuries closed today. A massive winter storm powering its way from the Midwest to the East Coast, grounding thousands of flights and shutting down the federal government, even though the worst of it skirted the nation's capital. Hampton Pearson has more on that storm that some in Washington are calling a snow quester.
In the Midwest, Winter Storm Saturn dumped more than a foot of snow, causing at least one fatality when the semi-truck slid into a river in Wisconsin. More backups in Dayton, Ohio, after another tractor-trailer collision there. Meanwhile, major airports have seen nearly 4,100 flight cancellations in the last 2 days, with another 7,500 flights delayed. Chicago O'Hare and Reagan National in Washington the most heavily impacted. 2013, weather experts say, continues the trend of more frequent and more costly weather events. But businesses are incorporating more long-range forecasting to prepare for emergencies and anticipate customer demand.
A lot of the major retailers are leveraging data like that and are factoring it in, but we're still sort of early days in the ability to really truly optimize against that kind of intelligence.
FedEx is no stranger to contingency plans around bad weather. And Walmart, the nation's largest retailer, has disaster command center personnel on standby with more capability to pre-position emergency merchandise before and after a storm hits.
We're just 3 months into 2013, but it looks like retailers could be among the economic weather casualties. Experts say too many made plans based on last year's weather, which was unseasonably warm.
Planning year over year is just a tricky business. If you assume the weather's going to be the same, it won't be. Statistically, it's only the same about 20% of the time.
Sometimes just the threat of bad weather can cause massive disruptions. Here in Washington, the federal government ordered 375,000 workers to stay home. But as you can see, it's just a little rain and mostly deserted streets here in the nation's capital. For Nightly Business Report, I'm Hampton Pearson in Washington.
Sports Illustrated magazine is out with its annual list of the 50 most powerful people in the sports business. There's the expected team owners and media bigwigs, league commissioners and the like, but number 10 on the list had a lot of people on Wall Street taking notice today. It's called Hedge Fund Dude. That's a catch-all title for 32 unnamed hedge fund managers who made enough money to be on the Forbes 400 list and own, in part or in whole, a major sports team, as the magazine puts it. Is there any cooler rich guy plaything than a pro team? Probably not, but a lot of those pro teams don't make any money, Susie.
You know who made number 44?
Who is that?
President Obama.
Wow.
A big surprise, not that he owns a business.
Big basketball fan.
He's a big basketball fan and player. And that's Nightly Business Report. And we want to remind you that this is the time of year your public television station seeks to support that makes programs like Nightly Business Report possible.
Absolutely. On behalf of your public television station, thank you for your support. Good night, everybody. We hope to see you back here tomorrow night.